Welcome to the deep dive. Today, we're really going to get into the world of digital assets using the material you shared.
Right.
Our goal here isn't just to, list definitions. We want to actually explore what they are, how this underlying tech works, the different kinds, and what you should know about investing. Try and make it make sense.
Yeah, exactly.
We'll be leaning on that Introduction to Digital Assets document. It covers quite a bit: definitions, tech, investing, risks, the whole lot. Okay, let's jump in.
Sounds good. Yeah, that document gives us a good starting point. So fundamentally, a digital asset is, well, it's an asset that's electronic.
Right.
Created, stored, transferred, all digitally. And it comes with ownership rights or use rights.
Yeah.
Examples. Cryptocurrencies are the big one, obviously.
Mhm.
But also all these different tokens popping up, even digital collectibles.
Okay, so it's about being digital, but the engine, the thing everyone talks about, is this distributed ledger technology, DLT, or blockchain. Why is that such a big deal?
Well, that's where things get really interesting. It's a fundamental shift, really, in how we track and verify information. Instead of one central database like a bank might have.
Yeah.
DLT is a shared database. It's copied across a whole network of computers' participants.
Right.
And each participant has an identical copy, all verified using cryptography. It kind of changes how we establish trust online, less reliance on those traditional middlemen, potentially.
So it's not just backups. It's
yes.
a totally different way to trust. Instead of trusting one bank or company, you're trusting the whole network's agreement. That's quite different.
Exactly. And to make sure that shared record stays accurate and nobody messes with it, they use pretty advanced encryption.
Right.
Think of it like unique digital fingerprints for data and digital signatures to prove transactions are legit. Now, while some cryptos, like Bitcoin, have their own blockchain, a lot of these other crypto tokens are actually built on top of existing blockchains. They sort of borrow the infrastructure.
Ah, okay. So using a shared foundation, the document mentions potential upsides for DLT, like better accuracy, transparency, security, faster transfers, peer-to-peer stuff. But it also hints at downsides. What are the main sort of limitations we need to keep in mind?
Yeah, that's important. It's not perfect, right? The potential is huge, but it's not inherently like 100% secure. Privacy breaches can still happen. And also, the computing power needed, especially for certain types of blockchains, can be massive, which means, high energy use.
High energy use, like running tons of computers constantly.
Basically, yeah. To keep that shared history accurate and agreed upon, all those computers, they call them nodes, need a way to agree. Which brings us to the consensus mechanism.
Consensus mechanism.
Okay.
Okay. How does this scattered network actually agree on what's true?
It's the process, essentially, how they validate new transactions and agree on updating that shared ledger. That agreement is what makes the records, mostly tamper-proof and transparent. The document mentions two main kinds: proof of work, POW,
Right.
and proof of stake, POS.
POW and PS. Okay. That's the one with the miners solving puzzles, right? Like a massive global math problem, and whoever solves it first gets to add the next block and gets paid.
That's a really good way to put it, yeah. Proof of work uses this computationally heavy sort of lottery system to decide who adds the next block.
Okay.
Miners compete, solve these complex crypto puzzles. First one validates the transactions, gets a reward, usually new crypto. The security comes from how incredibly hard and expensive it would be for someone to get enough computing power, like 51%, to cheat the system.
Oh.
But as we said, it uses a lot of energy.
Right. And proof of stake?
Yeah.
That's where you lock up your own crypto to vouch for transactions, like putting down a deposit.
Exactly. With PLS, it's not about raw computing power. It's about how much crypto participants the validators are willing to stake or lock up. A majority of these validators need to agree that a new block is valid, and they get rewarded for doing that, honestly. The security here is more about financial incentive: act badly, and you could lose your staked coins.
Got it. Different ways to get everyone on the same page. Now, the document also talks about permissioned versus permissionless networks. What's the key difference there for someone trying to get their head around this?
The main thing is who can participate. Permissionless networks like Bitcoin are open. Anyone can join. Anyone can see all the transactions.
Okay.
The plus side: no central boss, no single point. It can all collapse. You can interact without trusting one specific company. The downside: sometimes slower, maybe more costly, because everyone needs to agree.
Total open access.
Yeah.
And permissioned is more like a private club.
Kind of, yeah. Access is restricted. Only authorized folks can join. Maybe only certain members can add transactions or even just see them.
Right.
This often means things can run faster and cheaper, but you lose some of that pure decentralization. You're trusting whoever controls the permissions.
Makes sense. Okay, let's shift to the assets themselves. Cryptocurrencies are the obvious starting point. Bitcoin. What exactly makes something a cryptocurrency?
So the document calls them digital mediums of exchange. Purely digital, no physical form, usually issued privately, often using that open DLT we talked about. And crucially, they're generally not backed or regulated by governments.
Except for CBDCs, right? Central bank digital currencies.
Exactly. That's the exception starting to emerge.
So Bitcoin, back in 2009, this new idea for digital cash, maybe a digital store of value. And a big part of it is the limited supply, isn't it? Only 21 million ever.
Yeah, that scarcity is baked into its design. It's a big part of why people see value in it. And then you have, well, everything else, altcoins.
Altcoins.
Which is a huge category. Includes things like Ether, powering the Ethereum network with its smart contracts, all the way to stable coins. Those are meant to keep a stable value, usually pegged to something like the US dollar.
Stable coins, though we've seen they aren't always so stable, like that Terra USD collapse.
Yeah.
What was the deal there? Why did that fail so badly?
Terra USD. That's a really good example of the risks with algorithmic stablecoins. See, some stablecoins are backed by actual reserves, dollars in a bank, maybe bonds.
Right.
Terra USD wasn't like that. It used a complex algorithm tied to another crypto called Luna to hold its $1 peg.
Okay.
But when the market got shaky and Luna's price crashed, the algorithm just couldn't keep up. It failed, and both Terra USD and Luna basically imploded.
Wow.
It was a stark reminder that even things designed for stability can have hidden flaws in their mechanics. Very risky.
Definitely shows the complexity. And then meme coins. Dogecoin, Shiba Inu. These seem like they're mostly about internet hype.
That's pretty accurate. Often start as jokes, go viral, their prices can swing wildly, driven almost entirely by social media buzz and, community feeling.
Right.
Dogecoin started as a parody, right?
Yeah.
And interestingly, unlike Bitcoin, it was designed with an unlimited supply. It's a very different philosophy there. Their value is often highly speculative.
Okay, so cryptos are one big bucket. Then the document mentions tokens. How are tokens different from cryptocurrencies, practically speaking?
Tokens are generally broader, often built on existing blockchains, as we mentioned. The doc breaks them down. First, NFTs, non-fungible tokens.
NFTs. Heard a lot about those.
Right. They use the blockchain to create a unique, verifiable certificate of authenticity for an asset, often digital art, but could be other things too. Makes each one unique, non-fungible, like digital proof of ownership.
Like a digital CoA for art. Got it.
Yeah.
What about security tokens? Sounds more like traditional finance.
It bridges that gap, yeah. Security tokens aim to represent ownership in traditional assets, stocks, bonds, maybe real estate, but on a blockchain. The idea is maybe more efficiency in trading, settlement, maybe even breaking assets into smaller pieces. Fractional ownership makes things more accessible. ICOs, initial coin offerings.
Yeah.
That was an early, often unregulated way companies raise money by selling their own crypto tokens. Kind of like an IPO, but Wild West sometimes.
Unregulated sounds risky.
Oh, definitely. Then you have utility tokens. These give you access to something specific within a network, like paying fees or using special features. And governance tokens. These let holders vote on how a decentralized network is run, gives the community a say in changes and upgrades.
So users get a vote.
Cool.
And lastly, asset-backed tokens. Digital versions of real stuff.
Exactly. They're digital claims on actual physical or financial assets. Think tokenized gold or a fraction of a building. They're backed, collateralized by the real asset.
Right.
Allows for that fractional ownership again, potentially more liquidity. Because they're tied to real assets, regulators often look at these and say, yep, that's a security.
Okay, that paints a clearer picture of the different types. Now, how do people actually invest in this stuff? The document mentions direct and indirect ways. Let's start with direct.
Sure. Direct investment means you actually own the crypto or the token on the blockchain itself. To do that, you need a crypto wallet.
A wallet, right, to hold the keys.
Exactly, your private keys. That's how you access and control your assets. You usually buy these assets on exchanges. Two main types: centralized and decentralized.
Centralized exchanges, those are the big names we see ads for, yeah. User-friendly, lots of trading. But like the doc says, they can be a single point of failure. FTX, for example.
That's the big risk, yeah. They're convenient, liquid.
Yeah.
But they're private companies. If they get hacked or go bankrupt, like FTX,
Yeah.
users' funds can be lost or tied up, and regulation varies a lot depending on where they operate.
Okay. And decentralized exchanges,
Yeah.
DEXs, they're meant to be more like the blockchain itself, right?
Yeah.
No central control.
That's the idea. They run on distributed systems,
Yep.
no single company in charge. So they're generally more resistant to hacks targeting one central point. But they can be harder to use, especially for beginners. And because there's no central body, it's trickier to regulate, which can, open the door for shady stuff.
Different risks and benefits, then. The document also flags other direct investment risks: fraud, losing keys, whales. Can you unpack those a bit?
Sure. Fraud's a big one. Scam ICOs, pump and dump schemes where people hype a coin then sell off.
Right.
Phishing scams trying to steal your keys. Losing your private keys is devastating. If they're gone, your assets are basically gone forever, no recovery.
Ouch.
And whales, people or groups holding huge amounts of crypto, they can potentially move the market just by buying or selling big amounts. Manipulation risk.
Definitely need to be careful with direct investing. What about indirect routes for people maybe not ready for wallets and keys?
Several options there. You've got crypto coin trusts. They hold a big pool of one crypto, trade over the counter, like a closed-end fund.
Okay.
You avoid the wallet hassle, but there are fees, and the price might trade differently than the actual crypto value, than futures contracts.
Like betting on the future price.
Yeah, agreements to buy or sell crypto at a set price later,
Huh.
traded on regulated exchanges like CME Bitcoin futures. But they use leverage, so they can be very volatile.
Okay, more like traditional derivatives and ETFs. We're seeing more crypto ETFs now?
Right. Exchange-traded funds. They aim to track crypto prices. A lot of the current ones use futures contracts, though, not necessarily holding the actual crypto directly.
Oh.
Offers exposure in a familiar format.
Yeah.
Then crypto stocks, shares in companies in the crypto business exchanges, miners, tech firms.
So investing in the industry, not the coin itself.
Exactly. Indirect exposure, but company performance matters too, not just crypto prices. And finally, some hedge funds specialize in crypto using complex strategies.
Lots of indirect paths. The doc mentions decentralized finance, DeFi too. How's that fit in?
DeFi is this whole movement trying to rebuild financial services, lending, trading, borrowing, but decentrally, using smart contracts on blockchains, no banks in the middle.
Wow.
Asset-backed tokens often fit into this DeFi world. It's still pretty new, evolving fast, big potential, but also significant risks.
Fascinating. Okay, let's dig into risk-return diversification. The doc says digital asset value is mostly about expected price growth, scarcity, future use, not cash flows like stocks.
That's a really key point. You're not usually buying for dividends or interest. You're betting the asset itself will become more valuable over time.
Right.
Because more people will use it, supply is limited, or it disrupts something. Bitcoin historically shows that potential for huge returns.
Yeah, the stories are legendary.
But also insane volatility, huge swings. And importantly, at least early on, it didn't really move in sync with stocks and bonds. Low correlation.
That low correlation, that's the diversification argument, isn't it? If
Yeah.
crypto zigs when stocks zag, it could maybe smooth out your overall portfolio.
That's the theory, yeah. Historically, adding a bit could have improved risk-adjusted returns because crypto prices were driven by different things: adoption, tech, regulation, hype.
I sense a but.
Well, yeah. More recently, especially in times of market stress, those correlations have actually increased. Crypto has sometimes moved more like other risky assets. So that diversification benefit isn't guaranteed, and it seems to change.
Okay. And the risks are still pretty major. Volatility seems constant, regulation is still getting figured out everywhere, and fraud.
Absolutely. Look at Bitcoin's history: massive run-ups, then huge crashes. That volatility is still way higher than traditional assets.
Yeah.
The lack of clear global rules creates a lot of uncertainty. Investor protection can be weak. And sadly, yes, scams, hacks, illicit use, they're still way too common. Some countries have even banned cryptos entirely.
So wrapping this up, digital assets are this really new, complex thing based on DLT. Lots of different types, different ways to invest.
That's a good summary. And yeah, while there's this lure of high returns, maybe some diversification, you absolutely have to weigh that against the very real risks.
Volatility, regulation, security.
Exactly. Understanding the tech, the specific asset, the investment method, it's crucial before jumping in. You really need to do your homework.
Definitely. A lot to think about. Which leads to a final thought. Given how fast this is all changing, the tech, the rules, big institutions getting involved, how is the role of digital assets going to change in the next few years? what new uses or maybe new risks haven't we even thought of yet? It's
Yeah.
definitely something to keep watching. Thanks for breaking this down with us today.
My pleasure. It's certainly a dynamic space.